Hi, I'm Pattu from FreeFinCal. Let's take a look at the two IDFC Guild index funds that are currently in the NFO period. We had recently talked about the Edelweiss Nifty PSU bond plus SDL index, and just like that fund, this is yet another index fund that is also a target maturity fund. So, which means that after a particular date in 2027 and a particular date in 2028, the funds will close and the money will be given back to the unit holders. So the mutual fund industry is now trying out target maturity funds. It doesn't matter whether they're index funds or actively managed funds, but what they're trying to do is to basically combine two aspects of mutual funds. That is, one is open-endedness. That is, once the NFO period is over and the fund is available, in the fund opens, then people can freely invest in it and redeem from it. So there is an open-ended nature to it that is combined with this maturity date. Now let's talk about how this maturity date makes a big difference. Now suppose you hold a bond from let's say RBI. So let's not bring in any kind of credit risk here. We'll just keep it to either RBI bonds, or we will keep it to Government of India bonds. Sovereign ratings are a separate credit rating. They don't have a credit rating per se, I should say, at least for resident investments. So suppose I buy a bond from the Government of India and I hold it until maturity. There is absolutely no credit risk. I will be getting interest twice a year, and there's no problem. But if I suppose I want to sell it in the middle of the term, then I have to face the entire demand and supply risk of the market. Sometimes there may be demand for this kind of bonds that I'm holding, so the price will be higher than what I purchased it. I will make a capital gain, or the demand will be less, the price will be low, I will be making a capital loss if I try to sell the bond. Now, whether the mutual fund manager is going to sell the bond midterm or not, the NAV of a debt fund will always be marked to market. That is, the current price of the market will be reflected in the NAV of the debt fund. So what happens is that if let's say a fund is holding let's say gilt or government bonds of 1 month duration only, let's say a liquid fund, just pure fund like gilt fund, like more or less like Parag Parag liquid fund. The demand and supply forces in the market for 1 month bonds are not as strong as the demand and supply forces for, let's say, a 10-year bond or a 20-year bond or 30-year, 40-year bonds are even available. So what happens is, longer the duration of the bond, more will be the price fluctuations. So when in an open-ended gilt fund, these price fluctuations will always be there, and they will be there constantly. Whereas if I buy a gilt fund which has got a target maturity date, and I hold the investment until the target maturity date, or I sell close to the target maturity date, what happens is that with every passing year, the bond will head closer to its tenure. That is, for example, let's say this is a target maturity fund of 7 years or 8 years. They will be holding government bonds of 7-year duration, let's say. So in the first year, if I try to buy some units of this mutual fund, I will be having a 7-year bond in the portfolio. The volatility will be high. But after 2 years, it will become a 5-year bond. It would have aged to a 5-year bond. The volatility will come down. After it will become a 3-year bond later. The volatility will come down. So the volatility, that is called duration risk, or the volatility in the now, which is because of the demand and supply forces in the market, in the bond market, they will keep decreasing with increasing tenure of the funds, and as the funds are heading towards maturity. So by putting a maturity date to an open-ended fund, what the AMCs are doing is that they are gradually decreasing this interest rate risk. And if I'm going to buy these mutual fund units and hold them until maturity, whether it is lump sum purchase or SIP purchase or whatever it is, if I hold it until maturity, then the interest rate risk becomes virtually zero. the credit risk is anyway not there because they are investing only in gilt funds. So they have combined this, they have found a way to reduce this interest rate risk, I would say, and they have also eliminated credit risk by using a safe portfolio. This is an idea I talked about several years ago. I'm happy that, of course, I had a different idea in mind. I had something called interval funds in mind. They have now implemented it using a very simple idea, much more simpler notion, just by putting a target maturity. So this is the basically it's called the roll down of the duration risk. It just falls, it just keeps decreasing. So that is what these two funds are. So these are this is IDFC Gilt 2027 fund. This tracks the CRISIL Gilt fund of that same year. So they will have it has got I forgot, I wrote down the maturity somewhere. Somewhere here. Yeah, this matures on the 30th of June 2027. The other fund matures on the April 5th, 2028. If you look at the yields, more or less they are the same, about 6.1, 6.2%. This is the indicative yield. Of course, they are only going, this is the indicative yield of the index. If the fund manager buys the index portfolio, there will be redemptions, there will be inflows, there will be tracking error and so on. So roughly about 5.5, about 0.5 to 0.6% less you can expect just on the safe side before taxes. That's not a bad deal at all. And in this case, what they have done is they have designed the index in an interesting way. I don't know whether it is effective or not. At the very least, it is interesting. They have combined 98% of 6-year or 7-year gilt funds and 2% of treasury bills, that is 3-month treasury bills, that is money market instruments. So what they plan to do is, suppose during this 6 to 7 year period where the fund is operating, if the interest rate increases, then the treasury bills, they will be refreshing the treasury bills in the portfolio every 3 months. So the new treasury bills will be having a higher coupon rate, will be having a higher interest rate, and therefore that will help at least maintain the yield of the portfolio, or maybe slightly increase it. So that's not a bad idea. That's called a barbell strategy, where you buy 2 or 3 long-term bonds and then you compensate it with short-term bonds. Long-term bonds you buy and hold. Short-term bonds, they will get matured after a few months. Suppose if interest rate increases after a few months, then the new higher interest rate you will be having in the portfolio, which is not a bad deal at all. So whether should you invest in these funds? You can consider investing in these funds if your need is close to the maturity date, that is, if your need is after the maturity date, immediately after the maturity date, then you can definitely consider investing in these funds. Don't buy these funds if you're, these are 2027, 28 funds. Don't buy these funds if your need is like 2030 or 2035 or something like that. Then you'll have to pay tax unnecessarily on once they mature. So it's a good idea. Let's see how things evolve in the space.